What is your biggest financial concern? Are you being as intentional with your finances as you could be? How confident are you that you'll reach your financial goals? How will life's transitions impact your financial plan? Welcome to the Clarity and Confidence for Life podcast with Tom Fleishel, founder, president, and CEO of Fleishel Financial Associates. Discover how we can help business owners, successful families, and corporate executives achieve clarity and confidence for life while providing tailored financial solutions that eliminate complexity and free you up to focus on what really matters in life to you and your family. Now, on to the show.
Welcome to the Clarity and Confidence for Life podcast with your host, Tom Fleishel. I'm RJ Malik, producer of this podcast. Tom, good to see you as always, and I'm looking forward to another podcast. So why don't you welcome your guest and tell us what you'll be discussing on this edition of Clarity and Confidence for Life.
Thanks so much, RJ. Today, we're joined by Mike Sibley, CPA. He's a partner at James Moore & Company and a go-to expert for business looking to sharpen their financial strategy. So with more than 25 years of experience and leader of the firm's manufacturing services team, Mike helps owners and executives boost performance, streamline operations, and build long-term value through fractional CFO support and smart financial plans. So Mike also hosts the More on Manufacturing podcast, where he shares timely insights to help manufacturers navigate today's evolving landscape. So good morning, Mike.
Hey, good morning, Tom. Thanks for having me on.
So a lot has changed with this one big, beautiful bill that the current administration has enacted and Congress passed. So can you just break down what that bill really changed, initially for businesses and individuals in plain English?
Yeah, I think plain English is always the fun part here in terms of that. And, I'll just start off by giving my general kind of CYA that, today's all this is for education, and based on what we know of the law as of, September 3rd, we're expecting more guidance to come out from the IRS on this. So, some of the things that we know today may change. So this is definitely not tax or legal advice. And I always recommend people talk to their CPA or attorney before kind of acting on stuff. But let's jump into OBA. And I think, OBA is the one big, beautiful bill act. And, I guess that is there a more President Trump named kind of bill than that? But to set the stage for that, if you remember back in late 2017, we passed the Tax Jobs Act, and some of those provisions were actually going to start expiring after 2025. So they really needed to act. So, for example, some of the tax brackets were going to go back up. So there was the 198.9A for businesses was going to change. Depreciation was actually bonus depreciation was fading away. So Congress really needed to act and do something because this was all going to sunset. So they came up with what we call OBA. And it really actually changed quite a few things. There's a lot of dynamics. One, those tax rates I mentioned are not going back up. So the tax brackets, for this affects everybody. Tax brackets are staying the same as they have been. What's really interesting is for individuals, they have now no tax on tips, no tax on overtime, and you can even deduct car interest as part of that. So what this was really doing was getting to the heart of impacting everyone. Now, particularly those service workers and those workers who get paid on overtime. Now, I got to caveat that with everything. There's thresholds and phase outs for each one of these areas. And so it depends if you're single or married. There are phase outs and there's limits. But the practical side for those individuals are they should see a little bit lower tax on their income because they're going to be able to deduct some portion of the overtime. Now, what's going to be interesting for 2025 is their tax tables haven't been updated. So the payroll tax tables have not been updated at all. In 2026, that'll happen. So there's people that might get a little bigger refunds in when they file their taxes than they were expecting in the past, depending on how that overtime or tip ratio is compared to the past. Seniors, So those 65 and older now have an extra $6,000 that they get to deduct over and above their standard deduction. So that's great for them. Now there's some strategies they may have to look at because there's some phase outs, and some of these seniors have significant RMDs that could put them over the limits, and there's some ways to deal with that as well. For businesses, we're back to 100% bonus, which is great. That gives it bonus depreciation. So that's a great opportunity for them.
Well, let's hold up for just a minute. I want to go back to the question about the senior deduction, because a lot of people are thinking that Social Security is no longer going to be taxed. So I think there's a misconception there about what's happening with how that's impacting Social Security income for people. Do you have any thoughts about that?
Yeah, I mean, Social Security is still going to have its tax, and so how do you? The bigger question is, how do you start limiting what that is? Because Social Security tax is based on how high your income gets, and so the lower you can get that income, the less of Social Security that's taxed. And so one of the things you look at is, how do you manage that? And it could be, you got to look at your RMDs, you got to look at your investment income and maybe other forms of income. How do you defer some of that? How do you, if you're somebody that's very charitable, how do you take your RMDs perhaps and have it go straight to a charity? And that way it doesn't impact your income the same. So there's some different strategies you need to look at to help keep that Social Security tax as low as possible.
Yeah, thank you for that. That's good to get that clarified, because I know some people were thinking, oh man, it's going to change my Social Security taxation. Well, not really. It's just, I think the raise in the senior deduction maybe just lower the impact for some people, right?
It will. And again, even this has phase outs. So,
right.
We've got seniors that have high levels of retirement income coming in. And so that advantage can go away. And so now you start strategizing, how do you work around that?
And then, so for people for no tax on tips, that's also limited out based on a phase out of income, right?
It is. There's phase out of income, and then there's limitations on it. Now, the thing that we haven't gotten fully is the guidance of who qualifies in that realm. And so generally it's service workers. And actually, I just got an email today that the IRS has leaked a preliminary list of what those service workers are. And I'm telling you, it's a big, big list. So it's kind of the simplified version is anybody where tips are customary in their work should fall under that. So you're talking everything from certain casino workers to restaurant employees to bars to taxi driver. There's a whole list. It looked like dozens of. So there's going to be a lot of people who qualify under this to be able to get at least some level of deduction.
I know there was going to probably be some potential abuses there. People say, well, this income was tip income. So, right.
Yeah.
So
yeah.
There was that. I'm glad they clarified that, at least, because it was going to be kind of confusing.
Right. Well, and of course, some of it's hard to tell what the impact is going to be from the standpoint that, obviously there's, let's be real. I mean, some people get cash tips, and I don't know if that ever gets reported or not. Right. So how does that play into it? And then on the other hand, you may have single individuals who have kids, for example, and with their income levels, they're already getting their taxable income down to zero, regardless of tips. So they may not see much of an impact on this. So for each person, the circumstance is going to be a little bit different on whether this has a big impact or not.
Okay, so let's talk a little bit more about the business owner strategy. So there's this whole 100% bonus depreciation being now permanent. What does that mean, and how should business owners rethink asset purchases or deal structures?
Okay, so let's start with what is bonus depreciation, and what that allows us to do is take certain equipment purchases and other capital expenditures that would normally have to be depreciated over a period of time, and allows us to take it all at once. And what that does is it makes us think about, okay, what do I need to buy for capital equipment or capital purchases? And what's the timing of that? And can I speed that timing up by getting the cash flow impact of taking that deduction now based on where my taxable income is. So it's a tremendous benefit to be able to speed up our depreciation. That's the first thing. And when you look at ROI and you look at cash flow forecasts, if we can get a 30% reduction in tax, or 30% of that becomes our reduction in tax, that can be a really good cash flow brick. So that's the one thing we're looking at. The other side of it is, sometimes we hear 179. 179 is another deduction related to capital equipment that we can get. Here's where the strategy comes in. You have to look at your circumstance and say, which one is my better situation? Because if you're filing in different states, 179 might be better than bonus, because some states don't recognize bonus depreciation in the taxable income. So they need to look at 179. So you have to be really careful in your own circumstance as to what's the best provision to use. Now, when you're thinking about it in terms of a deal structure, if you look at from a seller standpoint, sellers, they always want to try to sell their stock first if they can, because they get capital gains rates on that. A buyer wants to try to buy the assets of the company. They don't want your stock, because your stock comes with all the old baggage that comes along with it. They want to buy your assets, and they want to mark up that purchase price allocation to put as much in fixed assets as they can, because then they get a bonus depreciation. So think about that from their cash flow side of things. They buy it, they have to spend all this money buying this business, and then they want to get a big deduction. The problem for the business seller is if they've written off all that depreciation, all that asset, now they have what's called recapture, which is getting taxed at ordinary rates on selling this business. Now we got to work out a deal with the buyers. Now we got to look at the tax impacts, and it is tremendous. And how do we do that? And by taking bonus, it can really zero out your basis in that, and ultimately cost you some recapture, some ordinary income on selling your business assets. So there's a lot of strategy that goes into how we deal with a structure of a deal, particularly in light of the ability to take all this depreciation. Very complex subject.
Yes, it is. So if someone's ready to sell a business in the next few years, how does this qualified small business stock QSBS bonus depreciation or EBL rules shape the deal? That's only for C Corps, right?
Right. Yeah. So first things first, the QSBS has been around for a while. What happened under the new law is it actually allowed a faster ramp time to reduce your gain. So what QSBS is it's a C Corp. It's for the first issuance of stock. And when you sell the stock, as long as you hold it for a period of time, that corporation, you can actually eliminate some or all of the gain on that. Tremendous opportunity potentially to eliminate the gain on that. The problem with that is you have to model out, does it still make sense to be a C Corp? Because remember what I just said about an asset deal? A lot of buyers don't want to buy your stock. And if they don't buy your stock, you don't get that benefit. So now you got to find a buyer who's willing to buy your stock. So that's one side of it, right? Because if you sell the assets of a C corporation, now you got all this cash that you're going to pay a gain on inside the business. And then when you dividend that out, you're going to pay capital gains rates on top of this. Now you got double taxation. So it's a really careful thing that we have to look at when we choose to go down the QSBS route. Now, on the other hand, as you model that out, you might say, yeah, but what if I sell to an ESOP? What if I sell my stock to an ESOP, put my stock in an ESOP? Now I get the tax advantage.
Let's talk, what is an ESOP? Make sure people know.
Great point. Yeah. So an ESOP is an employee stock ownership plan.
Yeah.
So that's where the employees, through a qualified trust, think about like a retirement plan, that's a trust, can actually buy the stock of the company. And so now the employees all share in the growth and the value of the company. So it's a benefit for the employees to want to see the company be successful, because if the company's successful, the value goes up. For a business owner, it's a great way to cash out some or part of the value of a business and, continue to be involved in the business, continue to allow a legacy, and sell the stock. So there's multiple ways that we want to look at, is a QSBS something that works for you or not? There's other models where it won't work because maybe you want to take distributions out of the business. There's so many different complexities to it. And unfortunately, with everything, there's not one right answer that's right for everybody.
Yeah, it's a pretty complex topic. Now, this whole SALT cap is interesting. So that was a big contention whether or not the Republicans were going to pass this whole legislation. They were fighting back and forth about those SALT limits. And let's talk about those again for the taxes on property taxes and the exemptions we get.
Yeah, it's really, so when we talk SALT, we're talking state and local taxes. So you're talking sales taxes, state income taxes, property taxes, things of that nature. In the past, long before 2017, if you were an itemizer, so if on your 1040 you itemized deductions, you could add up all of those different amounts and get a tax deduction for it. In 2017, part of the way that they, one of the things when they're writing this legislation for taxes, for every deduction that they come up with, they still got to figure out how to not kill the U.S. government in terms of the tax receipts that need to come in. So what they said is, hey, we're going to limit the SALT deduction to $10,000. Now, if you lived in a state like California or New York, where you're paying income taxes, property taxes, sales taxes, this was a big deal. This was a big deal for you. Of course, without getting too political, those states were obviously not big supporters of the administration back in 2017. So through the negotiation process this go around, they did increase that SALT limit to $40,000. Now, that said, high income tax earners or high income earners, that has a phase out as well. So it does go down to $10,000, which part of me, there's a little bit of comedy in this, I guess, or irony, because chances are if you're getting up to $40,000 in taxes, you're probably in the higher earning. Now, I don't want to stereotype everybody, but you're probably in that higher earning scenario. And so it may get limited anyway.
Yeah. So it's a gotcha anyway. They offer a nice little bait out there, but it's really not going to benefit the people that really need it the most, probably.
Potentially, because you think about the standard deduction for most people, if you're married filing jointly, is over $30,000. So what happened in 2017 is they really upped the standard deduction. So people who were itemizing, it got rid of most of the people who were itemizing.
Right. And
so it was a good benefit in a lot of ways because it made taxes simpler. But there are some strategies you can look at as if you're somebody that can sometimes itemize and sometimes not. So take state and local taxes, for example. You might have a year where hey, this year my income isn't as high, so I'm not going to hit those thresholds. But next year I think I'm going to kill it. Well, I might pay some of my state taxes earlier that I can delay until next year to try to beef up those deductions. Or I might say, 2025 was an unusually high year because something happened. I'm going to wait and pay my state taxes until January 1st, and then I'm going to pay next year's in December, and I'm going to double up. And you can do the same thing with charitable contributions to try to double up and take advantage of your income changes over time. And that's how you look at being able to maximize itemized deductions against your income and strategically placing that income.
That's a great strategy. Thank you. Now, what about homeowners, this idea of the mortgage interest and deductibility under those updated rules?
Yeah. So, for part of it was the mortgage interest is, again, something that has been deductible, but now you get the mortgage insurance premium that is now going to be part of mortgage interest. Also, what changed is part of this is now the debt limit is $750,000. So you don't get to deduct interest on those build or buy type scenarios if you go over the limits. I still go back to do you itemize or not? And this is going to be part of that. So if you're paying mortgage interest and you're also paying those premiums, are you even itemizing? So you got to look at your overall picture and say, how do I maximize this the most? Otherwise, it may not impact a lot of people. The numbers are staggering now of people that don't itemize their deductions. I want to say it's over 90%. I could be wrong on that, but it's a high percentage of people that don't itemize anymore because of the high thresholds.
Yeah. Now, one of the things that I think is going to change in 2026 is the change to the 401k catch-up allowance for plan participants over 50. And I'm kind of bummed about this because, I'm over 50 and I'd like to be able to max out my contributions, but anything over that on the catch-up is now going to be limited to after-tax or Roth contributions.
Yeah, and that may not be a bad thing, I guess. I guess it's on where your strategy is. I know, and Tom, you're probably way better at this analysis than I am, but having some money set aside after tax and having that balance out is sometimes a good thing. I kind of look at it both ways.
Well, we always tell clients to try to balance out, yes, pre-tax and after-tax. So most of the time people overemphasize one versus the other. So yes, you're right. It's good to have a balance of the two, but when you really need the deductions and want those deductions, they're kind of taking that away from us. And that's just like, okay, I get it. But now, an overreach is kind of where it goes, so that's the way the mop flops.
Well, and I think part of it too is if you go back to what I mentioned, earlier about how they have to balance some of the revenue aspects of these bills. So they want to give it on one hand, they want to give an advantage or they want to make some benefit, but they've got to offset it with something. Right. And, there's always that give and take. Otherwise it doesn't balance out right. And they they won't be able to get a deal through.
So back to the business owners for just 1 second. What about estate and gift tax planning moves should owners consider with the basic exclusion increasing? Is there any strategies there you can think of?
Yeah, this is, well, as you know, Tom, I mean, there was talks for a while where we thought this might go down to somewhere between $3 and $6 million. And now it's going up. So, I think the number's around 15 million per person now. And so that's phenomenal. And so one thing, we talk to everybody, and I know you do the same, is particularly if you have assets that appreciate in value. Think about a business that you are trying to grow in value or some piece of property, putting that in, gifting perhaps, or putting in certain types of trusts when the value is lower before it grows in that value can actually save a lot of your lifetime exemptions. And so that's what happens when you pass away and we use all your lifetime exemption. If there's still value left over, now we're starting looking at estate tax situations and how do we fund the estate tax. So the question is how do we reduce that? So for example, I've got a client that, has a business that's got about $1 million in EBITDA now. And our goal is to grow it to about $3 million of EBITDA and then sell it. Well, now would be a time where we can take some discounts and we can really reduce the value of that. If we're going to do some gifting and some estate tax planning, now's the time to do that because that business may be well worth more than $30 million down the road when we sell it. And on top of their other assets could really put them in a bad situation. So we want to be taking advantage of that now if we can.
Now, employers are going to be impacted to some degree by all this. So what updates should employers and lenders make to payroll and reporting systems to stay compliant?
Yeah. So, part of this, so from the payroll standpoint, what we're going to see updated tax tables next year for payroll taxes. We're also, W-2s are going to change. I know the IRS is supposed to come out with a fix for 2025 to be able to report the overtime and the tips, because that's got to flow down to the 1040s. So right now, the employers, if they're doing their own payroll in-house, need to be making sure that whatever system they're using is going to be properly updating for those things and how that's going to happen. Now, if they're using an external large provider, an external payroll company, it's still worth checking in with those companies to make sure they're going to hit the compliance side of things. And how are they going to do it? What can be expected? my guess is the big ones, they're already working on this, but it never hurts to make sure, because ultimately as the employer, you're still responsible to make sure those forms are going out correctly.
And so is that impacting, for example, like withholding tables affecting employee paychecks? Does that start in 2026?
Yeah, the withholding tables are going to start in 2026. For 2025, it's that's why, as I was kind of mentioning earlier, people may end up, if they have the same similar income as last year, they may actually see a little bigger refund if they normally get refunds, because the tax tables are still going to be holding a higher rate. So next year, I would expect those rates, those payroll tables to actually withhold a little less, which means somebody needs to be careful, because if depending on their situation, they need to make sure that whatever's being withheld makes sense, because if they under withhold for whatever reason, they could be looking at some interest owed to the IRS, and that's the last thing anybody wants to pay.
We don't want that. We don't want that.
No, absolutely not.
So what's the bottom line for our listeners today on the show? What would you say, just kind of bottom line, what were the big key takeaways for us?
Yeah, I think the big key takeaways. So let's start with individuals. I think if you're an individual, you need to go look at these thresholds, these different nuances in the limits, and understand how your situation falls into those, and see if you can't take advantage of some of these circumstances, like a SALT deduction, like the mortgage interest deduction, and some of these things by properly itemizing. And I always recommend talking to a CPA, tax advisor of some sort. For businesses, hey, right now you need to be thinking about, hey, what asset purchases do I need? Am I going to buy them? One thing I always say is, do not spend $1 to save 30 cents. Don't do that. Look at what you need. Can you speed that up? What's your taxable income now? Can you defer that taxable income by buying some equipment? And oh, by the way, there's a big research and development tax credit change that now allows us to go back to expensing again. It's a huge change, and you can even go back and amend tax returns over the past couple of years to go get that money. It doesn't make sense in all situations, but it may make sense in certain ones. So that if you're on the business side and you're doing R&D and you've been capitalizing that, you may have an opportunity to go get some cash.
That's awesome. I didn't realize you could go back and amend. That would be great.
Yeah, the IRS actually just came. We've been waiting for some guidance on that. They just came out with guidance on how to deal with the past tax returns on that.
So this has been a great update for us. Thank you, Mike. Now, I like to always wrap up my show with, is there a question I should have asked you that I didn't ask about any of these changes?
That's a good one. I think there is a good question. And I think when you get into estate planning and you mentioned retirement, conversation I'm having constantly is, how does all of this play into my retirement planning and my family planning? And I think, Tom, I think that's where you come in, is working with the tax advisor and the person to say, how do we maximize this? How do we improve this so that way we can improve your cash flow and your retirement down the road? And I think that's something that is often not discussed enough in the tax scenario. So it's like, you got your attorney, you got your CPA, and you got to have your financial advisor all in on all of the pieces.
Amen to that. You're preaching to the choir, because I talk about that in my book a lot, about the very important idea of having a team that works together, and they're all coordinating and communicating with each other about their tax situation, their estate plan, their retirement planning, and all those people need to be involved and coordinating together on the client's behalf. And I just think that's so important, and we don't see that enough.
Yeah, I agree. And I think, as we talk about things like hitting some of these gross income or adjusted gross income thresholds, investment income, as an example, gains, loss, all that plays into it. And it's really important that, you and I, Tom, are on the same page if we're working with the same person that might have some thresholds, because I'm seeing some aspects that you're not seeing and vice versa. So, if I'm a listener on this show, one, if they haven't read your book already, they need to read your book. It was a good book. I enjoyed it. I thought it was a lot of helpful tips on that. But I think second, that they need to be pushing to make sure that they've got everybody at the table to look out for their well-being.
You got it. Well, Mike, this has been very, very informational and helpful. I really appreciate your time. Thank you so much.
Yeah, happy to be on anytime. I always enjoy talking about this stuff, and kind of just to reiterate, all of this was educational only, and as the tax laws we know today, and again, any tax or advice, again, talk to your own CPA or attorney, and they'll be able to help move you in the right direction.
Excellent. Hey, Mike, before you go, can you give out some contact information?
I can. My email address is mike.sibley@jmco.com. And our main number, anybody can always reach us at James Moore & Company at 386-257-4100, or they can check us out online at jmco.com.
All right. And Tom, your turn. Contact information.
Yes, they can reach us at fleishelfinancial.com, or our number is 386-738-1800. Thanks so much.
Excellent. An interesting conversation to eavesdrop on. And most importantly, thank you for listening to the Clarity and Confidence for Life podcast. We ask you to share this podcast, rate it, and leave a review, because this actually helps others find the show. Again, thank you for listening. And for everyone at Clarity and Confidence for Life, I'm RJ Malik, and we look forward to you joining us for the next podcast.
Thank you for listening to the Clarity and Confidence for Life podcast. Click the subscribe button to be notified of new episodes when they become available. The information covered and posted represents the views and opinions of the hosts and/or guests, and does not necessarily represent the views or opinions of Raymond James. This content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional financial advice. Always seek the advice of your financial advisor or other qualified financial service providers with any questions you may have regarding your individual situation. Securities are offered through Raymond James Financial Services Incorporated, member FINRA, and SIPC. Investment advisory services offered through Raymond James Financial Services Advisors Incorporated. Fleishel Financial Associates is not a broker-dealer and is independent of Raymond James Financial Services.